Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me are Surbhi Upadhyay and Pavitra Parekh. Good morning, girls. Another trading session when the markets are just consolidating in a bit of a tight band. I think all 3 days this week, the markets have been...
50 points. I have to, sometimes I wonder if the screen is really
updating
frozen
itself,
or there's something wrong with the computer. Exactly. It's that kind of a market.
No, absolutely. Right now we're just down about 0.1% on the Nifty and the Sensex. Mid-caps yet again are holding up in the green. There is a bit of an outperformance, but just a wee bit, right? But this week itself, the mid-caps have outperformed the frontline indices by close to about 2%. Metals are having a field day today. So Tata Steel, JSW Steel, Hindalco topping the charts. Right now, you've got Bajaj Auto, which has moved up to the top gainers list. Divi's Laboratories has been a strong mover this entire month with a 17.5% rally. And on the losing side, IT has taken another leg down. So Infosys is the top Nifty loser. HCL Tech giving it company ahead of numbers tomorrow. HCL Tech is down 1.5%, and Tech Mahindra too is subdued in trade. That said, Infosys is trading at 1240. That's the rate on Infosys, but it's still higher than the low that it hit when it came out with their numbers on the 17th of April, and that is a number below 1200. So let me just revise that number for you. Yes, 1185 was the low that Infosys hit when it came out with their numbers. So while the stock has corrected today, it's still trading above that level. So very, very quiet, right, as things currently stand, very range-bound, listless.
Yeah, absolutely. I think this market's been trying to get direction, but it's just not successful. So I think the action remains very, very stock-specific, whether it's earnings or a news trigger, and that's what we saw yesterday and more of that today as well. Let's pull up the contribution plate. Like Reema mentioned, obviously IT is seeing fresh selling, and that's a little disconcerting. The upside is that you'll find Reliance contributing a little more, but then there is an ICICI Bank that's nervous ahead of results. So it's all kind of netting each other out. And finally, the tally on the Nifty is just about 17 odd points lower. You can see that today HDFC Bank, Axis Bank are better off, but ICICI Bank has been the drag, and obviously the IT issues continue. Because there's not much happening on the index, I thought let's pick out something interesting, perhaps from the broader market. Found one such trend. Rice stocks are quite hot. They are up between 3%, 4, 5, 6%, depending on which one you're looking at. There you go, KRBL 7.5%, LT Food. If you're wondering what's happening, well, there seems to be a global rice shortage in the works. This is according to Fitch. Fitch is saying that global supplies are at the lowest level in the last 20 years. There's bad weather in China and in Pakistan. That's disrupting production, and prices are the highest that they have been in a decade. So some of the rice stocks, particularly the exporter companies, obviously we're a huge basmati rice exporter. At least that's where, there's some action, something to talk about. Pavitra?
Well, just to add one more point on that subject, is this going to hurt inflation? I think that would be the next question, right? Because India is pretty much a rice-eating nation as well, though we do export a lot of basmati. There was this interesting analysis, coming out of Nomura, where they're saying that inflation is likely to undershoot RBI's projection, and as a result of which, they're expecting RBI to go in an extended pause and then go ahead and begin its rate-cutting cycle in October. So based on the daily price data from the 1st to the 17th of April, their provisional estimates suggest that the April CPI inflation is tracking below 5%. It's actually at 4.5 to 4.7%, a sharp fall compared to 5.7% in the month of March. While it's very early because it's only data from the 1st to the 17th of April, according to Nomura, so you are caveating it. But preliminary estimates, according to them, say that CPI inflation may undershoot RBI's projection of 5.1% in Q2. That's the April to June period, and that could be a reason to send RBI into an extended pause before they begin rate cutting in the month of October. So just some, since you spoke about netting off, right? There is netting off taking place at the equity level, sectoral levels. So just to net off the inflationary impact of possible increase in rice prices, the other data seems to suggest inflation is very much under control.
All right, very interesting. No, that's from Nomura over there. You were talking about the stocks which are doing well today because you really have to look for these individual pockets, right? So metals is what you pointed out. Autos are also once again doing well, and this is after that sector has already seen an over 6% kind of move in 1 month. The results are also going to start coming through. Bajaj, Maruti will go in the next couple of days. So some amount of focus could shift to that pack as well. Once again, doing well in terms of the auto names. IT, like Reema was pointing out, is weak, and the mid-cap IT names also really taking it on the chin. So keep those on your radar. The other space that's really not doing well is the entire insurance space. Of course, ICICI Lombard we've been speaking about since the morning. It's down almost 4% right now. But the rest of them, also the larger HDFC Life, SBI Life, also seeing some cuts there. So that's what's happening in terms of the market action. Very quiet on the surface, but there is lots of action in terms of individual stocks. We will talk more about that. But first up, let's kickstart the show now by bringing you an interesting conversation. Sunil Subramaniam is MD and CEO of Sundaram Mutual Fund, and he joins us now to discuss the way forward for the market and what really we could see from here. Sunil, thanks for joining us as always. This is Pavitra. You know, ever since the earnings started, specifically what we've seen with IT, the market seems to have just paused. There's really not much going on. How do you think it's going to move from here as we do start getting more and moving out just from the IT earnings as well?
See, basically, this is going to be a nervous period for the market. So, one, because of the earnings season. Second, it's a summer, there's a heat wave. There was an anticipation that consumer discretionary, consumer durables would see a summer pickup. So the commentary around that coming in when the earnings season comes, people naturally are questioning about how is the current quarter looking. And I think that data is important. What do the companies feel about demand in consumer this month? Then you have the El Nino impact. I know SkyMet and India Met have given slightly varying opinion on the monsoon this year, but the El Nino effect is again, and you mentioned about rice prices rising worldwide. So I think that is again a cause of nervousness for the markets from perspective. So I would say this quarter is generally going to be this way, not much movement. On IT specifically, since you mentioned, see, IT, I would say, is still got room to correct in my perspective, because the whole COVID level, when the IT went through a kind of safety to growth up valuation move, I think has not entirely gone away. And because the US kept showing some signs of recovery, there was a hold on the IT pack saying they might recover. But I think the banking crisis, and BFSI is a big buyer of IT services. And the banking crisis, if that means that there's going to be less ordering, the US recession signs as they come through, credit defaults are beginning to rise slowly in the US. So I think the nervousness around the IT pack in terms of business growth for the year will need a lot more clarity, and maybe the earnings season commentary will give us that.
Sunil, hi, good morning. Surabhi, this side. Let's talk a little more about the sector that you represent, financial services, and it's early days. We just started hearing from companies, for instance, ICICI Lombard. I mean, there's some hiccups there in terms of business growth slowing down, not as robust as perhaps what was anticipated earlier. And again, even for mutual funds, I mean, we all know the factors too well, a lot of regulation, taxation changing on the debt side. So specifically for insurers, mutual funds, let me throw in wealth managers as well, the listed ones at least. What's the house call, and how are you looking at the non-lending part of financial services?
So I think, overall, the trend in terms of growth of business for both insurance, asset management and wealth management, all the three sectors, we see that India's per capita GDP, we expect it to double by the end of the decade. And we expect that while a certain amount of consumption will shift, let's say from consumer staples to discretionary, the net consumer surplus in their hand is definitely going to increase. And to the extent that we expect rate cuts happening from the second half of the year, we expect interest rates from banks and fixed income. All of these three are very heavily regulated. And I think India as a regulation, right, we are trying to be among the best in the world. So a lot of practices that prevail in the developed countries are being brought in here from an investor protection angle, from a market depth angle. To that extent, the cost pressure, right? Because it's also passives coming in play. In asset managers, there are passives. On the wealth side, stockbroking, there's a lot of passives coming in. So generally, there's going to be a pressure on cost for this. So you have an expanding basket. You have the regulatory overhang, like the 5 lakh insurance premium taxation, like the regulations that came in terms of SEBI is talking about TRs and all of that. So there is going to be a balance between the pie itself increasing and the margins reducing. So overall, on an EPS growth perspective, I think it should be stable over the medium term. But in the short run, while that growth picks up, there would be margin pressures. So you will see a slightly volatile a movement in their EPS and the valuations consequently. But from a medium term, if you are looking at it from a 3 to 5 year perspective, I think these are excellent sectors to invest in, given the overall scenario that consumer surpluses in India are going to go up. savings per capita is going to go up.
Sunil, in your many years of experience, decades of experience, you have seen many cycles of technology, the up cycle and the down cycle. Suddenly, there are renewed concerns on the technology spend, what the outlook for the Indian IT companies will be, and even the management commentary has changed overnight. In the month of January, companies were singing a very different tune compared to what they are right now. How would you classify the current environment, and is the weakness that we are seeing, because most IT names have corrected about 5-10%, some of them even more than that in the last couple of days, doesn't make it an attractive buying opportunity? Or would you wait it out?
Yeah, so I would say between January and now, what happened was the banking crisis, right? And I mentioned in my earlier chat. So the Silicon Valley crisis and the Credit Suisse crisis, and to see whether there's any ripple effect, means each of these banks is going to focus more on getting their asset liability, their risk management practices better. So they're less likely to go on an expansion on the IT framework. So I do see that business for IT companies from the BFSI sector would be under pressure, right? Number one. So as a result of which is why the commentary, I think, has been changing. Number two. Number three factor is that I still believe that the US is still not clearly coming out of a recession path. So IT development, right, has got a correlation on two aspects, right? One is it's a large part of the user's cost base. So in a recession, they will tend to try to reduce the cost. So they will go and renegotiate with the Indian companies to bring down cost, number one. Number two is that in terms of expansionary IT, the Internet of Things, the artificial intelligence, all of those new things which were being talked in COVID will be on slightly on hold. But the third aspect here is that while I'm overall as a pack, I'm just neutral on the IT space, there are company specific, because in this whole rush to drive down costs, right? One company could go and outbid another. And I would still see individual IT companies coming out winners at the cost of others. So it's a very highly stock specific situation at this stage. Some of the IT companies have corrected to reasonable values where we would like to accumulate them, but not all of the IT pack. So it's I would say both a wait and watch and a stock specific outlook at this point on IT, but definitely it's not a blind IT buy at this point.
Okay, got that. Sunil, how are you looking at the entire real estate space? You know, ever since we got that pause from the Reserve Bank, the sector has rallied, I mean, some 11-12%. Would you look at these stocks? Do you think it's a good time considering, what's going on with interest rates as well?
Yeah, I think so, especially if you look at the high end, a lot of high-end projects are being launched and being sold out within days. So clearly at the HNI levels, everybody is looking at a second or a third home outside of city in a larger space where they're looking to chill out and relax over the weekend. So the additional home buying, I think, has picked up. And I think the real estate sector, you're seeing rentals sharply shoot up. So as a result of it, as an investment also from a HNI's perspective, real estate is suddenly looking attractive, because even if you put in the cost of borrowing and take the tax break into it and look at the delta between the rental yield and the net cost of your loan on this, I think that's down to about 2.5 to 3%. So which means if you're just coming in 2.5 to 3% monthly cash flows, you're able to buy another asset and the rental yields are going to go up. So I see that real estate is a good pack, because the other point that I mentioned, that consumer surplus is going to be higher. So savings would be higher. One aspect of savings, India likes to save in physical assets by the way of real estate. So one portion of that savings I do expect to get reallocated away from bank deposits into real estate, because to me the rental yield then makes it a very attractive regular return compared to a bank deposit or a company fixed deposit. So that's another avenue where I see savings being diverted to the real estate pack. And I think there are a lot of launches, for example, the alternate space, right? There are a lot of AIFs which are being launched in the real estate. Our company also has got 3 or 4 of them, and they are seeing great demand. And so developers there are eager to take loans to grow this business. So I think we are reasonably bullish on the overall real estate pack. Of course, remember that is a very, very city oriented, in the sense specific cities will see oversupply, there you go easy, other cities are growing rapidly. So I would say that you can't apply the rule, just as I said for IT, it's not a blind thing across. We've got to look at local demand supply, and the IT sector is a big buyer of real estate. So when I said about the IT sector, there'll be some amount of impact of that. If the salaries are not going to go up so much, then maybe the demand from that slightly cools down. So very IT-centric cities, real estate would be a very different perspective from another business like a Mumbai, which is a financial services place. So I think it's a very city-specific play, but overall, given the scenario of a doubling of per capita GDP, we think that real estate will be one of the beneficiaries. And the government, of course, thanks to the employment generation capacity of the construction real estate business, is going to continue to support it through SOPs, through various levels.
Okay, all right. Sunil, good listening in to you. Thank you for joining us on the show today. And we look forward to our next conversation. Well, the markets are absolutely quiet, 13 points lower on the Nifty. Let's take a quick break. We'll find out what's happening in the world of commodities. Manisha Gupta will join in with the latest.
Welcome back. You're still tuned into Trading Hour here on CNBC-TV18, and let's talk about the world of commodities now. Manisha joins us. Manisha, we were just discussing how in a very flat market as well, the rice stocks are really surging. So tell us what's going on there.
Well, rice has been in favor for some time now, and especially after the Fitch report, which says that the rice crop will see a decline in 2023 to the lowest in 20 years. And that really seems to have ignited the rice prices and the stocks as well. Well, interestingly, we have seen rice take support from various factors. Since the Ukraine war, rice clearly has been slightly choppy there. And then there are weather woes that we've seen in China and Pakistan that has led to a decline in crop. As per a USDA report, the Pakistan crop is estimated down by 31% on a year-on-year basis. And Pakistan is an important market when it comes to rice crop there. There also is lower production in European Union and US, and that's weighing on. And remember, the prices in Asia Pacific have been on the higher side because nearly 90% of the world rice is consumed here. The global shortage for 2022-23 is estimated as of now at around 8.7 million tons, though the markets do believe that by the time we are into 2024, you could be looking at higher sowing because of these higher prices. At this time, it also is about the Ramadan demand, the El Nino impact. The sentiment also seems to be getting insight into the prices there. Indian markets also are looking at quite interesting numbers here. When you look at the rice exports for 2022-23, the initial estimates show a record export of around $11 billion, which is 16% higher on an year-on-year basis. In sense of quantum, 21 million tons or thereabouts is not very high from last year, but it clearly is about the value part here. The markets also are looking at higher exports of basmati rice. Remember, 4.5 to 5 million tons that India exports is nearly 80% of overall world trade when it comes to basmati rice. So the markets are looking at better demand and higher prices because of that as well.
Okay, thank you very much for that big move in all these stocks today. KRBL 8.5% higher. Kohinoor Foods also surging in trade. Get into a break. On the other side, we'll talk more about the markets. We'll also get you a roundup of some interesting trends on investor behavior. Sandeep Bharadwaj of HDFC Securities will also be joining into that discussion. Welcome back. Surbhi's now moved over to the big wall. She's standing by with a roundup of some interesting details on investor behavior of late. Surbhi, what are you picking up based on March numbers?
Well, March data from the exchanges and depositories is throwing up some pretty interesting investor behavior trends. First of all, the trend of new demat account openings is slowing down. Now, though the total number of demat accounts continues to rise at an absolute basis, the incremental new account addition is what is seeing that drop. March actually saw 19 lakh new demat accounts being opened as opposed to 21 new lakh accounts being opened in February. In fact, this trend, you can say the decline has started in January after having a decent end to the year. The number is also well below the monthly average of 29 lakh new demat account openings that we saw throughout FY22. So if you average out every month of FY22, then we were at 29 lakhs. That number for March is down to 19 lakhs. So that tells you about the pace of the decline. Now, lackluster markets are probably the key reason behind this drop in fresh demat account openings. And that could also be the factor behind the steady decline seen in NSE's total active client base, which has been falling for 9 consecutive months, according to Motilal Oswal, and it's come down to 326 lakh accounts in March. Now, mind you, even though the number of NSE active clients is almost down 9.5% in March of 23 versus last year, discount brokers aren't complaining. Their dominance actually has been growing steadily throughout the last 1 year, with the top 5, that is Zerodha, Upstocks, Angel One, Grow and 5 Paisa Capital, making up now for 60% of the market share. Let's come to another interesting trend, and this is retail investors, or should I maybe say retail traders, increasing their interest in the futures and options market. Let's look at the basic turnover trends to begin with. Now, despite the market remaining absolutely flat over the last 18 months, average turnover has been pretty healthy. In fact, it's up from 95 lakh crores in March of 22 all the way up to 236 lakhs crores. That's almost 150% jump in that 1 year period. Now, this is largely courtesy the rise in F&O volumes. Let's look at the average daily turnover in the F&O segment, which is up in March 148% over last year, and it's a 13% increase compared to February 23. It's not just seasoned traders, but retail has also decided that it doesn't want to miss out on the F&O opportunity. Motilal Oswal points out that retail segment average daily turnover has grown about 12.5% in March over February, the month-on-month growth if you're talking about Feb 23 and March 23. But the more stunning comparison is on a year-on-year basis. If you look at the average daily turnover in the F&O segment, retail turnover, then we're talking about a massive jump. From a level of 40 lakh crores in March 22, that number has moved up to 87 lakh crores in March 23. Contrast this with the cash market activity, and cash market retail volumes have actually dropped in the same period, the year period, by a little over 28%, and they've come in at about 237 lakh crores. So there we have it. It's quite clear that the retail investor is willing to experiment with newer ways of making money and is perhaps heading from the cash to the futures and options market. Well, that's the data. Let's try and figure out, whether this is a real new emerging trend that's here to stay, or is this an aberration because of the way the markets have been. We have Sandeep Bhardwaj, COO and CDO of HDFC Securities, now joining in. Sandeep, thanks for being with us. So I was looking at sector-wide trends, and I think, a lot of it is very apparent if you're looking at numbers from, let's say, Angel One or some of the other big discount brokers. But you tell us, is it really just that? The cash market is not allowing you to make quick money. It's been a painful long wait, and that's why perhaps retail or a section of retail really wants to now try their hand in the F&O segment.
Sure, thank you for having me here. See, I think largely number you have already shared, from Demat new account, Demat participation, from ADTO participation, derivative, we already seen over 100% growth in retail turnover. The market, which is over 40, has already moved over 80 lakh crore. And on a cash side, if you look at the cash side, which was 33,000 crores, has come down to 23,000 crores. I'm talking about retail cash participation. Now, let's look at what's happening in terms of customers holding. How customers are holding. One interesting number which I want to share, which that retail ownership of NSE listed universe has declined from 16-18% from 2001, 2002 to 8-9% 22. It means the total market capitalization of NSE listed company retail only holds 8-9%. Vis-a-vis what has happened during the COVID, this 8% grew to close to 10%, which we are again seeing a decline of 52 basis point by financial year 23. So ownership level, other than turnover basis, ownership level also, we are seeing a downtrend in terms of people holding that. And let's look at why people, trades in derivative, because it's in various forums, it has been talked about the derivative turnover is growing. But why people trade in derivative? Today, if you look at Nifty,
before, if you could just allow me to comment, because you mentioned a very important point in terms of ownership. I think you mentioned NSE 100, right? You said ownership in terms of retail investors owning these companies, it went up to about 10% in COVID, and now it's come down 56 basis points.
Yes. So if you look at 2001, when it used to be
Sandeep, what I'm trying to understand is that while COVID, obviously, it's a no-brainer, right? People were sitting at home and they were coming to equities directly. There was a lot of direct stock picking happening, but SIP numbers are still very strong. So retail investors are still investing through mutual funds. Then what accounts for this decline in ownership of NSE 100 companies by the retail segment?
See, if you look at the SIP number, month on month, it has already reached 14,000 crore, close to 14,000 crore. So it's like a tactical shift of retail participating in indirect equity. In direct equity, from a stock point of view, it is always a pain for retail customers to choose pick and choose stock, and it also emotional where people end up booking losses or profit quickly. Vis-a-vis in mutual fund SIP, it is a long-term instrument. People are stick to in terms of their behavior. So I would say it is a shift. It's a tactical shift in from direct equities to mutual fund way of investing. And as far as ownership is concerned, we saw, I think from 2001 till 2019, it was a constant decline in terms of ownership of NSE listed companies. But during COVID, when we saw close to 2% of the ownership high, which again we are noticing that it has already down by 6 basis point.
So this retail ownership number of 10% that we are currently at, close to that. That takes into account the SIP numbers, right? This is not just direct investment into...
Yeah, this is mutual fund investing also. Yeah.
This includes that. And despite that, we are seeing a drop in the overall equity participation and ownership.
I'll give you another interesting point. So retail investors was net buyers in 2020. They bought close to 500 million. That happened after 11 long years. The net buying before that came in 2001. Post that net buying came in 2020. We have always looked at mutual fund net buying versus net selling. But when you look at retail, this has happened after 11 long years. And between 20 to 22, then they invested close to 2.79 trillion in NSE capital market. But when you look at current, December last quarter 2022, we have seen again 1.42 billion of selling happening out of it. It means the people are either a profit booking or they are booking losses. They are moving out of retail equities.
Okay, got that. Sandeep, let me come to you on the F&O figures as well that Surbhi was talking about, right? We're seeing some big numbers there, and perhaps this money in a market which is just moving sideways is now moving to F&O in hopes of perhaps better returns over there. Take us through what else you're picking up, and is this, considering that we have been talking about the fact that this entire year is likely to be like that, we're not likely to see much in terms of a gain. Do you think this is a trend that's likely to continue? And of course, any other trends if you have picked up from the F&O space as well in terms of retail participation?
F&O retail participation, if you look at this is March 23, it is to 3.2 million. So which is constantly, growing from derivative point of view. Cash, we've already seen, the markets have seen a significant decline on retail participation. But F&O participation, there is a strong, growth, and it is growing. So which was 31.5%, which was the market share, retail market share in derivative, has grown to 35.6% market share in overall market share. So which has taken it to 40 lakh crore to 87 lakh crore, which is over 115% growth. But what we need to understand is why people are trading in derivative, why option. So when you look at, you buy one Nifty contract in future, you end up buying a 1 lakh, future or cash for that matter. You have to have either 100% of the margins in cash, and future is close to 1 lakh rupees of margin for a current Nifty value. But the same thing if you want to buy in the money, at the money call, you only require 2,000 rupees close to margin, which is 2% of the total value, which is very, for retail point of view, which is not a very big number. So that encourage people to take positions into derivative, especially into, options.
Sandeep,
so I personally see that this is continue to grow.
But I'm sure from your standpoint, you'd love to see this grow. But I'm just wondering, I go back to SEBI's study. Remember at the start of the year, SEBI came out with a study that 90% of active traders have actually lost money in the futures and options market in 2022. I'm sure SEBI is also noticing and watching these trends. So would you expect regulatory action? Retail's getting active in not futures but options because margins are lower there.
It's largely options. It's largely options.
Yeah. So do you think there'll be action from the regulator?
I think regulator in last 2 years have taken a lot more action in terms of building up peak margins. So there is a uniformity, and brokers don't give excessive margins to people without adequate position, without having adequate margins. So by this peak margin regulation has already played a significant role. But in spite of that, we are noticing the constant growth in derivative turnover. And that largely happens because your invested surplus, where over the invested surplus, as I already explained you, for buying a one Nifty at the money call, you need to only have margin of 2,000 rupees. And even if you earn 500 rupees over it, which becomes a 25% gain, which against you take it on a future, which becomes a less than a 1%, or in terms of cash, your surplus amount is very high. So that discourage people to maybe participate in cash or maybe future to some extent. And options becomes a direct beneficiary for that.
Well, let's see if the regulator intends to change that a little bit, exactly because, as you said, you need to put a margin of 2,000 rupees and you can, trade in options on that. Very interesting trend, Sandeep, and thank you for joining in and expanding, of course, the data points that we were looking at. Good talking to you. Thanks for being with us. Okay, well, there we have it, the rise of retail in the futures and options market. We'll take a quick break on that note. Lots more coming up on the other side.
So the market is attempting a bit of a move higher. We have recovered a little bit right now, just around 5 points in the red for the Nifty. So you are seeing a move. We've been talking about the metals pack, of course, but a lot of the pharma names also moving well. So Divi's is at the high point of the day. You have Dr. Reddy's, which has moved up. Reliance, by the way, has seen a significant move upwards. It is currently at the high point of the day as well, 0.7% there. And take a look at ITC, because that one has spiked once again. And currently, that's also seeing quite a sharp move higher. So that's what's happening with the market action. But let's get you a technical check now. Mitesh Thakkar joins us for exactly that. Mitesh, very, very flat day on the surface. Of course, you have, action in these individual names. But do you think on a day like today, you would play perhaps the individual names over taking a call on the index?
Good morning. I think that's the approach which I've been suggesting for the last couple of days. The index appears to have come out of the uptrend, gone into a sideways consolidation. If you look at the hourly and the 2-hourly charts, while the daily and the weekly are still positive. So the broader trend is on the upside, but the immediate trend is kind of, of consolidation and maybe a slightly choppy one. So try to buy on decline. So on the index, I think I would want to enter around 17,600 to about 17,580 zones with a stop below 17,545. And till then, I think, avoid IT, but the other area is where, we're exploring a long position on stock. So clearly the bias is on the upside, but on the index, you would want to have a tactical entry and try to take profits as we get closer to about 17,800.
Okay, book profits closer to 17,800. So that range continues. Mitesh, what about individual stocks? What would your recommendations be?
I have 2 buy calls. Axis Bank is something, which is coming out of a consolidation. That's a buy with a stop just below levels of 858 and look for targets of around 885 on the upside. The other one is Coromandel. That's a stock which has given a good price and volume breakout today. Buy here with the stop just below levels of 934. Look for targets of 985.
All right, got that. Mitesh, thanks very much for the calls. We'll touch base with you again later in the afternoon. Quick break right now. On the other side, we are in conversation with the management of Jindal Stainless. Get a quick sense on the business there.
Welcome back. Let's get a corporate conversation going. Jindal Stainless is on our radar. The board has approved a special interim dividend for FY23 upon the conclusion of the merger process. So they've announced a dividend of 1 rupees per share, and this is also on account of the completion of the merger and the subsequent listing of new shares of the merged entity. Also last month, towards the end of March, it signed a nickel supply pact with Indonesia-based New Yeking. We're now joined by Anurag Mantri, the Group CFO of Jindal Stainless, to discuss more on this. Mr. Mantri, morning. This is Rima here. The first question is this a one-time dividend that you have announced, or do you think from here on we can expect consistent dividends from you? Is there a dividend policy that you would like to set in place?
Good morning, Rima. This is first after a long time we declared the dividend. As you know, we just completed the historic merger process of 2 large listed entity into stainless steel, which is Jindal Stainless and Jindal Stainless SR. So now there is only one entity listed, and now with this we get into the top 5 in the world in the stainless steel segment. Now this was we completed this process. The new share got traded on April 11. And immediately then the board meeting was convened to start our dividend journey from here onward. So as you rightly said, this is the start of our dividend journey after last dividend was declared long back in the splitted entity in the 2008. And now onwards, I think this is based on the current special interim dividend based on the 9 months number. And as we complete our financial year, the board will again evaluate the further dividend. So it was, I would say, it's a start of the journey. We are into the growth phase in terms of the way we have restructured entire the business model in terms of the margin stability. This is now actually to reward the shareholder in a right manner.
Okay, Mr. Mantri, you've gotten into an agreement with New Yanking PTE. This is development, construction, and operation of a nickel pig iron smelter in Indonesia, apparently. Can you tell us more? What sort of backward integration is this? What's the rationale? And you're paying a fair amount of money for it, 157 million. So then what happens to the utilization of cash? What are your cash levels? What happens to your plans of paying down debt?
Yeah, so see, this is a very unique, and this was the first one by an Indian company to get control on the nickel asset. As you know, India does not have any nickel resources of the right quality of nickel resources. Stainless steel is one of the large consumer of nickel, and the other consumer, which is the growing users which are going for nickel, is actually into the EV batteries value chain. And this is a very unique JV where we are getting into the 49% stake in a nickel rotary kiln rotary kiln furnace, where we'll be getting the nickel NPI as well as some of the nickel outputs, which can be also used into the electric vehicles side, EV battery chain. We will also not have a risk of any of the operational risk of managing the entire mining and any other operation. It's only a more 49% stake where we'll get a commercial beneficial interest. The payback for this project is very fast. It's just 2 years within the start of the operation. Overall, I think within 4 years, we should have a full payback from the construction till the payback. So overall, this and for us, the nickel is one of the key raw material, and because of various geopolitical situation you have seen last 1 year, nickel has been very, very volatile. Though we have changed our business model and we brought quite a lot of stability in our margin, this will further enhance and improve our margin stability, because with this, the nickel volatility is also it gives us the raw material security, and to that extent that it reduces the further volatility on the which is on depending on the nickel.
Totally got that point, Mr. Mantri. By how much? So you're saying the facility will be up and running in 2 years' time, and when it's commissioned, since it directly feeds into your raw material security, can you give us some sense, or by how much do margins go up? Can you quantify the benefit, basically?
See, the IRR of this project is more than 25%. I would say, I think let's wait for, because we will not be getting the entire output here. We have a flexibility to bring the output, use the output, as well as also sell in the open market, including the EV battery chain side also. So overall, we are expecting a good 25% IRR. I think let's wait for some more time to give you very specific number, but the IRR of the project I can tell you, which is more around 25, more than 25%.
Okay, got that. Thanks for joining us, Mr. Mantri. This is Pavitra. Can you also tell us then what this does to your overall debt and what is the plan there? You have spent 157 million on this. So can you tell us what the debt looks like now?
See, I think the debt which we our last published debt was actually on the December result, which was around 2,800 CR. As you know, we are in silent period. I cannot give you the March number, but overall, with this FY24, we will have 2-3 large capexes. One is this, as well as the JUSL acquisition. The other one is the Rathi Super Steel acquisition, which we completed. So we are expecting around 2,500 crore capex in FY24, which will largely be funded by internal accrual. The debt could actually move up around 500 to 700 crore during intermittent period when all these payments bunch up. But overall, there is no significant increase in debt we are expecting beyond that. So our debt equity is one of the best in the metal industry. It's less than 0.5. Right. And we continue to maintain a debt equity of less than 0.75 during this process.
Mr. Mantri, when we last spoke to you, you said a capex of 2,000 crore is what you've lined up for FY24. Now you're saying it should be 2,500. So have you upped your capex plans?
Not really, I would say, because there were some spillover capex of JUSL acquisition which was to happen in FY23. Those have not happened. And this is this nickel asset was also some of the new asset. So it's not much of the difference. I'm saying 2,500 because there are some spillover capex as well as some of these nickel pig iron capex, as well as all the Rati, some capex on the Rati maintenance capex.
And you said your debt was about 2,800 crore as per the last reported numbers. There could be an increase of about 500 to 700 crore rupees, right? Based on the requirement as and when you proceed with this capex. So that brings us to a number of 3,500 crore. Can we assume 3,500 crore approximately should be your peak debt number? Because I think the last time we spoke to you, you gave us a number of 5,000 crore. So just wondering if that number appears to be on the higher side now.
No, so there is a one difference of 5,000 crore number included the number of subsidiary of 2,000 crore JUSL, which is one of our hottest strip mill subsidiary. That's the number. Besides this, there is a 3,500 crore number could go during the year. I'm not saying because all these spend will happen during the in a staggered manner in FY24. So for an intermittent period, the debt could increase by 500 to 700 crore, but the ratio will remain intact and will remain very strong.
Okay, got that. So 5,000 is basically the consolidated debt number, got that. What is the outlook on EBITDA per ton? I think the earlier level that you indicated for end FY23 was about 19,000. So what about this year?
This year, our guidance was around 20,000 of EBITDA per ton, and that is on a standalone basis. And then JUSL could add up to another EBITDA of around 3,000 rupees per ton.
All right, Mr. Mantri, thank you very much for joining us and taking us through your outlook and also speaking to us about this dividend that you have declared. We hope to speak with you soon again and get in some more details. But for now, we're going to wrap up that conversation and take a break. But we are going to come back. There's lots more market action that we're tracking, so stay with us.
Blue, red.